Today is Wednesday, 21st of May, 2025 Eastern Time. This news is brought to you by Preeti Capital, your trusted source for financial insights. Today's financial markets provided a complex tapestry of movement, underscored by the dynamic interplay between robust sectoral performances and the ever-present undercurrents of geopolitical tension. The technology sector, a stalwart of recent market rallies, once again emerged as a beacon of growth, pushing major indices upward. This sector's rise can largely be attributed to sustained innovation and strong earnings reports that continue to impress market participants. Investors have shown a renewed appetite for growth stocks, particularly in firms that are spearheading advancements in artificial intelligence and cloud computing technologies. Conversely, the broader market sentiment remains tempered by global uncertainties that cast a shadow over economic forecasts. The geopolitical landscape, fraught with unpredictability, has kept investors on their toes, necessitating a cautious approach even amidst the gains. These uncertainties are not only limited to international relations, but also extend to trade policies and regional conflicts that could potentially disrupt global supply chains. Commodities and currencies have responded to these broader geopolitical cues with their own unique movements. The commodities market, often sensitive to geopolitical tensions, has seen fluctuations particularly in oil and precious metals, which are traditional safe havens during times of uncertainty. Meanwhile, currency markets have exhibited volatility, with investors monitoring central bank policies closely as they navigate the challenges posed by inflation and economic growth rates. In summary, while the day has seen significant gains driven by the tech sector's impressive performance, the underlying market sentiment remains cautious. Investors are balancing the optimism of sectoral growth with the pragmatic need to hedge against wider geopolitical risks. This complex backdrop suggests that while there are opportunities for gains, a vigilant and informed approach remains essential for navigating the current financial landscape. In the latest session, the performance of major indices globally provided a mixed picture of market sentiment. The S&P 500 experienced a slight decline, losing 0.39%, indicating some hesitancy among investors, possibly due to prevailing economic uncertainties or profit-taking after recent gains. Similarly, the Nasdaq Composite edged down by 0.38%, reflecting a pullback in the technology sector, which has been experiencing volatility amidst shifting interest rate expectations and regulatory concerns. The Dow Jones Industrial Average also saw a decrease, dropping 0.27%. This suggests a cautious outlook among market participants, with perhaps a rotation out of blue-chip stocks as investors reassess their risk profiles. Conversely, the Russell 2000, a key gauge for small-cap stocks, posted a modest gain of 0.05%, highlighting a slight appetite for risk in domestic-focused, smaller companies that might benefit from a stronger U.S. economic backdrop. The VIX, often referred to as the Fear Index, remained unchanged, signaling that while there is concern in certain sectors, overall market volatility expectations are stable for now. Over in Europe, the FTSE 100 and the DAX both recorded declines of 0.10% and 0.21%, respectively, amid ongoing geopolitical tensions and economic data releases that may have dampened investor sentiment. In Asia, Japan's Nikkei 225 fell by 0.61%, potentially reflecting concerns over economic growth and the impact of a weaker yen on the domestic economy. However, the Hang Seng Index in Hong Kong rose by 0.39%, buoyed by optimism in the Chinese market, as evidenced by the Shanghai Composite's gain of 0.21%. This uptick may be attributed to positive developments in China's economic policies or corporate earnings, which have provided a boost to regional investor confidence. Overall, the mixed movements across these indices underscore a landscape of cautious optimism, with investors balancing potential growth opportunities against prevailing economic challenges globally. In the current financial landscape, bond yields present a nuanced picture of investor sentiment and economic expectations. The 10-year Treasury yield, a critical benchmark often referenced to gauge long-term interest rate trends, and economic confidence, currently stands at 4.481%. This yield indicates a modest increase, highlighting a market environment where investors are demanding slightly higher returns for holding government debt over a decade. Such movements can reflect a range of factors, including expectations for future inflation, economic growth, and monetary policy adjustments. Meanwhile, the 13-week Treasury bill yield is at 4.248%, showing a more significant uptick. This short-term indicator is closely watched for insights into the Federal Reserve's interest rate trajectory and liquidity conditions. The rise in this yield suggests that the market anticipates potential rate hikes or a tightening monetary environment, which could be a response to persistent inflationary pressures or attempts to curb excessive economic overheating. The 30-year Treasury yield at 4.967% has experienced a more pronounced increase. The substantial movement in this long-term bond reflects shifting expectations about future economic conditions and inflation over an extended period. A higher yield in this segment may signal concerns around sustained inflation or a reassessment of long-term growth prospects. Investors may demand higher compensation for the increased uncertainty associated with holding long-duration assets in such a volatile macroeconomic environment. Overall, the upward trajectory across different segments of the yield curve suggests a market grappling with complex dynamics, including inflation risks and potential shifts in central bank policies. These yield movements underscore the importance for investors to carefully consider their duration exposure and the broader economic signals being conveyed through the bond market. As the situation evolves, monitoring these yields will be crucial for understanding both immediate and future financial conditions. In recent trading, the currency markets have exhibited noticeable shifts, underscoring the dynamic nature of foreign exchange rates. The US dollar index, a critical barometer for gauging the greenback's strength against a basket of major currencies, has dipped slightly. This decline, albeit modest, reflects a 0.41% decrease, positioning the index just below the 100 mark. Such a movement suggests a weakening stance of the dollar, potentially influenced by recent economic data or shifts in investor sentiment. Meanwhile, the euro has strengthened against the dollar, evidenced by an uptick of 0.36%. The euro's appreciation could be attributed to positive economic indicators within the eurozone or broader market perceptions of stability and growth prospects in the region. This movement marks a notable moment for the euro, as it continues to navigate the complexities of post-pandemic recovery and ongoing policy adjustments by the European Central Bank. Similarly, the British pound has experienced a rise of 0.36% against the dollar. This appreciation might be driven by market optimism around the UK's economic outlook or anticipations of future monetary policy actions by the Bank of England. The pound's trajectory underscores its resilience amidst fluctuating market conditions and geopolitical factors. Conversely, the Japanese yen has seen a decline of 0.45%, reflecting its depreciation against the dollar. This movement could be a reaction to varying interest rate differentials, as the Bank of Japan maintains its ultra-loose monetary policy stance. The yen's depreciation may also be influenced by investors seeking higher yields, thereby shifting capital flows away from traditionally lower-yielding assets. Overall, these currency movements highlight the intricate interplay of economic indicators, central bank policies, and investor strategies that continually shape the forex landscape. As market participants adjust their positions, these fluctuations offer insights into broader economic trends and potential future directions in global currency markets. The commodities market is currently experiencing varied movements across different sectors, reflecting a mix of investor sentiment and underlying market dynamics. Gold prices have seen a notable increase, climbing by approximately 0.89%. This uptick may be attributed to a combination of factors, including inflationary pressures, geopolitical uncertainties, or a weaker dollar, as investors often flock to gold as a safe haven asset during turbulent times. Silver has also seen a modest rise of 0.23%, which might suggest a similar safe haven dynamic at play, although its industrial applications could be influencing its price movement differently compared to gold. The slight increase may also reflect ongoing demand from industries such as electronics and solar panels, where silver is a critical component. Crude oil prices show mixed trends, with Brent crude rising by a significant 1.07%, while West Texas Intermediate, WTI, has only seen a marginal increase of 0.10%. The stronger performance of Brent crude could be linked to supply concerns or geopolitical tensions affecting European and Asian markets where Brent is the benchmark. In contrast, the smaller increase in WTI may indicate a more balanced supply-demand situation within the U.S. market or a response to domestic economic data. Natural gas has experienced a decline of 0.38%, which could be due to seasonal factors such as milder weather forecasts, reducing demand for heating, or an increase in supply due to higher production levels. The natural gas market often exhibits high volatility due to its sensitivity to weather conditions and storage levels. Copper, which is often seen as an economic bellwether due to its wide range of industrial uses, has risen by 0.64%. This increase may suggest optimism about industrial activity and economic growth, particularly in China, which is a major consumer of copper. The rise could also be driven by supply disruptions or shifts in inventory levels. Overall, the commodities market presents a complex picture, with each asset class responding to a unique set of influences, from geopolitical developments and economic indicators to supply chain dynamics. Exchange-traded funds, ETFs, have become a cornerstone for investors looking to diversify their portfolios across various sectors with relative ease and efficiency. Recently, the sector-specific ETF landscape has shown mixed performance, reflecting broader market trends and sector-specific dynamics. The SPDR S&P 500 ETF, a barometer for the broader market, experienced a slight decline, indicative of general market softness. Similarly, the Invesco QQQ Trust, which tracks the tech-heavy NASDAQ 100 index, also saw a minor dip. This could suggest cautious sentiment among investors, possibly due to concerns over interest rates or geopolitical tensions affecting tech giants. Conversely, the iShares Russell 2000 ETF, representing small-cap stocks, posted a modest gain. This uptick could signal investor optimism around domestic economic resilience and potential growth in smaller firms, which are often more sensitive to economic cycles. The Financial Select Sector SPDR Fund saw a more pronounced decline, which may be attributed to rising interest rate fears or regulatory concerns impacting financial institutions. On the other hand, the Healthcare Select Sector SPDR Fund showed a slight rise, reflecting investor confidence in the defensive nature of healthcare stocks, which tend to perform well in uncertain economic environments. Energy has been a volatile sector, and the Energy Select Sector SPDR Fund's notable drop aligns with recent fluctuations in oil prices and ongoing discussions about energy transition and sustainability efforts. Meanwhile, the Technology Select Sector SPDR Fund mirrored the broader tech trend with a slight decrease, possibly reflecting profit-taking or sector rotation. The ARK Innovation ETF, known for its focus on disruptive technologies, registered a small gain. This might indicate renewed interest in innovative sectors as investors seek growth opportunities despite broader market uncertainties. Overall, these sector ETFs present a snapshot of current investor sentiment and sector-specific conditions, with each reacting to a complex mix of economic indicators, policy changes, and global events. Investors continue to navigate these waters, balancing risk and opportunity across diverse market segments. In today's stock market activities, the landscape was marked by a mixture of gains and losses across various sectors. The tech giants experienced slight declines, with the most noteworthy being a modest dip in several key players. Among them, a leading tech company's shares fell marginally, reflecting a broader trend of cautious trading within the sector. Another technology behemoth saw its stock price decrease slightly, while a prominent chipmaker's shares also saw a minor decline. These movements suggest a period of consolidation as investors assess the future growth potential amidst economic uncertainties. On the financial front, the banking sector showed a mix of slight gains and declines. A major financial institution managed to edge up, while another saw a slight dip. The mixed performance in financial stocks may reflect ongoing apprehension regarding interest rate policies and their impact on the banking industry's profitability. The energy sector, however, faced more significant challenges, with several major companies experiencing noticeable declines. The downturn in oil prices seemed to weigh heavily on these stocks, leading to a sell-off in shares of leading energy corporations. This sector's performance highlights the volatility and sensitivity to global oil price fluctuations and geopolitical developments. Conversely, the healthcare sector exhibited a strong performance, buoyed by substantial gains in pharmaceutical companies. A leading pharmaceutical company posted a notable increase, perhaps driven by positive developments in its drug pipeline or favorable regulatory news. Additionally, robust performances were seen in other healthcare stocks, indicating investor confidence in the sector's long-term growth prospects. Consumer goods and retail stocks displayed mixed results. A major home improvement retailer saw a slight drop in its share price, while a well-known athletic apparel brand experienced a modest gain. These variations reflect the diverse consumer spending patterns and economic conditions impacting retail and consumer goods. Overall, the day's trading activities underscore a market characterized by sector-specific movements and underlying economic factors influencing investor sentiment. As the market continues to navigate through a complex economic landscape, sector performance and individual stock movements remain closely tied to broader economic indicators and global events. The technology sector continues to be a dynamic and influential force in the global market, with its stocks often reflecting broader economic sentiments. Recent data reveals a mixed performance among major tech entities, hinting at underlying market apprehensions and sector-specific challenges. Semiconductor companies, integral to various technological advancements, exhibited a slight downturn. Notably, NVIDIA and AMD saw declines, with NVIDIA decreasing by approximately 0.88% and AMD by 1.07%. This could be attributed to fluctuating demand dynamics and competitive pressures within the semiconductor industry. However, Taiwan Semiconductor Manufacturing Company, TSMC, showed remarkable resilience, with only a minor dip, suggesting relative stability in its operations or strategic positioning. In the realm of consumer technology, Apple faced a near 0.92% decline. This may reflect investor caution amid concerns about consumer spending patterns or potential supply chain disruptions. Other tech giants like Microsoft and Meta also experienced minor decreases, indicating a broader trend of caution among investors. Interestingly, Tesla, a key player in the tech-driven automotive industry, bucked the trend with a modest gain of 0.51%. This positive movement might be indicative of optimism surrounding its recent developments or strong delivery numbers. Cloud and enterprise software companies presented a varied picture. Salesforce, for instance, managed a slight increase, whereas Snowflake showed a healthy gain of 0.46%. These movements suggest that while there is confidence in cloud services and enterprise solutions, the market remains selective in its enthusiasm. Conversely, Airbnb faced a significant decline of over 3%, potentially reflecting changing travel dynamics or increased competition in the short-term rental market. Similarly, other companies like Zoom and Uber also saw reductions, which could be linked to evolving post-pandemic consumer behaviors. Overall, the technology sector remains a barometer for market sentiment, balancing between innovation-driven optimism and caution amidst global economic uncertainties. As companies navigate these waters, their strategic pivots and operational efficiencies will likely dictate future performance trajectories.